Thank you for joining us at xm.com for this weekly Outlook video. I'm Christina Marujas, and joining me today is investment analyst Marios Hadjikyriacos. Of course, we'll be having a look at the week ahead. It's relatively a quiet week, one would say, but it is going to be rich in data. So let's start by having a look at the UK. It's reporting employment data for June on Tuesday, inflation on Wednesday, and of course, retail sales on Thursday. Now, do you think these reports will affect the pound, or is it all Brexit for the British currency?
I'd say the latter all day. We've seen the British currency literally ignore economic data for months or quarters now. The Brexit story is by far the most important driver for the currency, and the explanation, the logic behind this is quite simple. If you manage to solve the political crisis, most of the economic problems go away as well. So investment picks up, uncertainty dissipates, and growth reaccelerates, let's say. So in that sense, while the data could attract some attention, I think that most of the focus remains on Brexit. On that front, Boris Johnson continues to play chicken with the EU, basically, and we've seen reports lately that EU diplomats don't even think that the UK wants to negotiate. So the outlook still looks dark for the pound, in my opinion, and right now a no-deal Brexit looks more and more likely. Now, what could turn this tide? Perhaps signals for a general election or a no-confidence vote in the government. Unfortunately, the earliest date when this can happen is September the 5th, so there's very little prospect for a rebound in the pound over the next month at least.
Well, let's cross the Atlantic now into the U.S. It's reporting CPI inflation and retail sales this week. Of course, markets will be looking closely at these reports as it might give some signs as to how aggressively the Fed will cut rates in September. Now, how will that affect the dollar?
Well, we've seen bets for a Fed rate cut in September soar lately. So a 25 basis points rate cut is fully priced in, and very similar to the July meeting, we also have some expectations for a 50 basis points more aggressive rate cut. Now, I believe that the Fed is only likely to cut by 25 again, and the arguments are very similar to what happened in July. We've seen some of the most dovish Fed members, Fed officials come out and say, maybe we should wait a little bit and see the effects of the latest rate cut. Maybe we shouldn't rush into so much easing. So they very well might cut, but I very much doubt it will be by 50 basis points. Now, what does that mean for the dollar? Market pricing is essentially overly dovish at the moment. So if we see Fed officials push back against this over dovishness by the market in the coming weeks, that could help the dollar to recover a little bit, at least in the near term.
Let's have a look at China. It's also reporting a lot of data this week. However, the trade war with the U.S. is ongoing. It rekindled recently. However, reports out of China recently have been better than expected. So do you think the data out this week will support that, or are dark clouds beginning to gather around the world's second largest economy?
Well, the forecasts at least point to a slowdown in the Chinese economy, and considering how much trade tensions have escalated and therefore uncertainty has arisen lately, I'd say that's fairly accurate. So we might see this data, come in slightly weaker. That could show that the trade war is starting to inflict some real damage, even despite the stimulus measures by the Chinese authorities, by the way. But what does that mean for the markets in general? It could affect risk appetite, the yuan, the Aussie, perhaps stocks. But I think the bigger driver for all of these assets will be what happens in the trade war. So right now, the Trump administration looks likely to escalate things and maybe introduce another round of tariffs as early as September. I think that's pretty likely, and I believe that is the case because Trump might want to fire up his base a little bit and energize, play the tough on China sort of role with his base ahead of the US elections. So we might see some more escalation, and in that sense, I think risk aversion might be here to stay.
And finally, let's have a look at Australia, which is reporting employment data this week. If that data is not strong, do you think we will see the RBA signaling another rate cut at its next policy meeting?
The RBA already cut rates at the last 2 out of its last 3 meetings, so it has been active. Now, market pricing implies another 40% chance for another cut at the September meeting. Overall, I don't think the RBA will be in such a rush to cut again. Maybe they could pause for a little bit and see what happens to the economy, particularly since the employment data, at least the forecasts, suggest that the labor market was relatively decent during that month. The net change in employment is expected to have risen a little bit. That would be a slightly encouraging development for the RBA, and it could slightly diminish the odds for a cut in September, which therefore could lift the Aussie a little bit. But having said that, the broader outlook for the currency remains negative overall. You have the trade war casting a long shadow over the Australian economy, and even if the RBA does not cut in September, it will most definitely cut before the end of the year again. So there's very little to suggest a rebound, a sustained rebound in the Aussie.
Marius, thank you for joining me today, and thank you for watching us at xm.com.